If you think America's next recession will start on Wall Street, you're watching the wrong screen. It may start in a parking lot, the moment millions of working Americans lose the one thing that gets them to work, their car. America's car market is flashing one of the clearest economic warning signals we've seen in years, yet it remains largely ignored. Not because cars don't matter, but because the system that makes them look affordable has quietly stopped working in real life. This is not just a story about high prices. It's a story about how the United States transformed basic transportation into a long-term debt product, then layered an entire financial ecosystem on top of it. And now, that ecosystem is beginning to fracture from the bottom up. When mobility breaks, jobs break. When jobs break, spending breaks. And when spending breaks, recessions don't stay theoretical. The first crack is already visible. Auto loan stress is no longer spreading evenly across the economy. It is concentrating, and that concentration matters. Among subprime borrowers, people with weak credit and little financial margin, missed payments have surged to the highest levels in more than a decade. At the same time, prime borrowers remain relatively stable. On the surface, that looks reassuring. In reality, it is exactly how downturns begin. Economic stress never arrives everywhere at once. It starts where resilience is weakest, then climbs. The early stages are quiet, statistical, easy to dismiss. But once pressure escapes the weakest layer, it accelerates rapidly. This split explains why the economy can still appear strong while something more dangerous builds underneath. Because even as defaults rise at the bottom, the top of the auto market still looks glossy. New car prices haven't cooled. They've crossed the psychological line. The average transaction price has pushed above $50,000. That figure isn't just symbolic. It's structural. At that price level, the problem is no longer taste or preference. It's math. And when math breaks, markets adapt in ways that often look clever in the short term and destructive in the long term. Americans don't really buy cars. They buy monthly payments. The industry understands this better than anyone. When prices exploded after 2020, manufacturers and lenders didn't solve affordability. They postponed it. Loan terms stretched quietly. 5-year loans became 6. 6 became 7. 7 became 8, even 9 years. Not to help consumers, but to preserve sales volume in a market where real affordability had already collapsed. This shift created what looks like stability on paper, a monthly payment that feels manageable today. But the contract behind that payment is built on a fragile assumption that the borrower's life will remain smooth for nearly a decade. No job loss, no reduction in hours, no medical emergency, no insurance shock, no major repair. That assumption is fantasy for millions of households. This is the payment illusion, a system that lowers the visible cost by stretching time, while quietly increasing total burden. The longer the loan, the slower the principal falls. The higher the rate, the more interest is front-loaded. The car itself, meanwhile, depreciates relentlessly. Eventually, the illusion collapses. Some argue that interest rate cuts will fix this, that as borrowing costs fall, pressure will ease. But this misunderstands how auto credit actually functions. Auto loans do not price off Federal Reserve policy alone. They price off risk perception. And when lenders see defaults rising, especially in subprime, they do not loosen. They retreat. Approval standards tighten. Down payments rise. Fees increase. Refinancing options disappear. So even if the cost of money falls, the cost of permission rises. That distinction is critical. Lower rates mean very little if fewer people qualify. And this is how credit contractions begin quietly, without panic, without headlines, without crashes. Just fewer approvals, fewer buyers, fewer sales. Now layer in the most destabilizing force of all, negative equity. Millions of Americans bought vehicles during the inflation surge, when prices were detached from long-term value. Today, those vehicles are worth far less, but the loans attached to them did not fall with prices. This gap traps borrowers. They cannot refinance because the collateral no longer supports the balance. They cannot sell without absorbing thousands of dollars in losses. They cannot trade in without rolling debt forward into a new loan. The vehicle becomes a financial anchor, not an asset. Longer loan terms make this far worse. With extended financing and higher interest rates, borrowers reduce principal painfully slowly. Even households that make every payment on time can find themselves deeper underwater month after month. This is not reckless behavior. It is the predictable outcome of a system designed to prioritize transaction volume over sustainability. And this is where the story turns from personal hardship into systemic risk. Auto loans are not isolated contracts. They are bundled, sliced, and sold as asset-backed securities. These products rely on steady cash flows and predictable recovery values. They look safe when prices are stable. They become fragile when delinquencies rise and collateral weakens at the same time. When repossessions increase, vehicles flood auction markets. Auction prices fall. Lender losses widen. Investors demand higher yields or pull back altogether. Funding becomes more expensive. Credit tightens further. That tightening pushes even more buyers out of the market, reinforcing the slowdown. Repossession is not the end of the chain. It is the lever that converts household stress into broader economic contraction. The pattern is uncomfortably familiar. Loans tied to weakening collateral. Financial products built on optimistic assumptions. A market that functions smoothly until it suddenly doesn't. This is not a repeat of 2008. Auto debt is not housing debt, but the mechanism rhymes in ways that should not be ignored. There is another risk that receives far too little attention: mobility. In America, losing a car is not a minor inconvenience. It is often a direct threat to employment. In vast regions of the country, there is no functional alternative to driving. No reliable transit. No backup plan. Lose the car, lose the commute. Lose the commute, lose hours. Lose hours, lose income. That is why auto stress spreads faster than many other forms of consumer debt. A credit card can be juggled. A car cannot. The day the vehicle is gone, economic participation collapses. And once participation collapses, defaults do not remain isolated to one loan. They spill into credit cards, rent, utilities, and healthcare. The damage multiplies. There is also a quieter accelerant hiding in plain sight: insurance. Even if a loan payment remains fixed, insurance rarely does. Premiums have surged across much of the country, driven by rising repair costs, expensive components, vehicle complexity, theft risk, and labor shortages in the repair industry. Insurance functions like a silent rate hike. And unlike a loan, it is non-negotiable. Many lenders require full coverage. Many states require insurance to drive legally. For countless households, insurance is the final cost that breaks the monthly equation. For years, these pressures were concentrated among subprime borrowers. That boundary is now shifting. Middle-income households are increasingly exposed to the same forces: high prices, long loan terms, elevated insurance, stagnant real wages, and rising everyday costs. Many remain current on payments, but only by draining savings, delaying medical care, or cutting essential spending. That is not stability. It is postponement. And postponement is how economic pressure builds invisibly until it suddenly cannot be absorbed anymore. Here is how this pressure turns into a recession, step by step. Defaults rise first among the most vulnerable. Credit tightens as lenders protect themselves. Fewer buyers qualify. Dealers lose volume. Manufacturers cut production. Suppliers reduce shifts. Workers lose hours or jobs. Consumer spending falls. No crash is required. No panic is necessary. Just enough households quietly stepping back. This is how recessions actually begin, not with a bang, but with erosion. So is auto debt the single cause of the next downturn? No, but it is one of the most powerful transmission channels in the modern consumer economy. It links affordability, employment, credit markets, and spending into a single fragile loop. When Americans can no longer afford the basic cost of mobility, the economy does not collapse overnight. It decays. And decay is dangerous precisely because it is gradual. It is easy to ignore, easy to dismiss, easy to explain away until it is everywhere. The real risk is not that the auto market collapses spectacularly. The real risk is that it quietly undermines the foundation of consumer participation at the exact moment households have the least resilience left. That is why the car market deserves far more attention than it receives. Not as a niche sector, not as a lifestyle story, but as a structural stress test for the American economy itself. Because when the cost of simply getting to work becomes unsustainable, the problem is no longer transportation. It is the system. Do you think America's next recession starts with auto debt and mobility loss? Or with something bigger like jobs, housing, or credit cards? And why? No noise. No spin. Just analysis.